Retail sales for the month of February showing sales falling 1.5% for food, services, and drinking places. This comes as fast casual food stocks have fallen over the past month. We've got recession fears. We've got concerns over consumer spending worries. Joining us now, BofA Securities senior restaurant analyst Sara Senatore. Good to see you, Sara, as always here. So let's talk big picture first, right? And talk about all of these concerns that are swirling. We saw the numbers this morning in the retail sales report. What's your read on how fast casual, QSR, et cetera, is doing in this environment?
Yeah, well, thank you for having me. Nice to be here again. I will say that a lot of this was anticipated by, some of the commentary that the restaurants made on their fourth quarter earnings calls. So, most of them reported their fourth quarter well into February. So they had some line of sight to what was happening. And I think essentially what we saw is a big headwind from weather in the month. So, not just unseasonable cold weather, but really, road closures in parts of the Midwest and the South, restaurants that were closed. So that does put a damper. I mean, even on pizza restaurants, which typically benefit when people stay home, and some other restaurants that have like sort of a home meal replacement product. If the driver can't get to your house because the road's closed, that's not helpful. So I think, what we saw is really idiosyncratic in the sense of we had a little bit of a calendar shift. Valentine's Day fell on a Friday instead of a Wednesday. There were all kinds of things, less leap year. I mean, there were all kinds of things that played a role. And now as we're coming out into March, we're seeing a little bit more normalized demand.
So normalized demand, perhaps. What about on the cost side? What about on the tariff side? What about on the labor inflation side? What kind of trends are you seeing?
Yeah, so I think, having listened to a couple of your earlier, guests, I guess, I'm like Jerome Powell. I'm waiting and seeing, right? So we haven't actually had any impact from tariffs because, there's been so much back and forth. They haven't actually gone into effect. What we do know is most restaurants source domestically, but there's no question that if there are tariffs on our big agricultural trading partner like Mexico and other partners, there's going to be an impact. It's probably somewhere in the 100 basis point range, somewhere between 50 and 200. It depends on the sourcing. It depends on how much of the inputs. And of course, it depends on the knock-on effects. If there are tariffs on imports, then that means local production actually, it has to meet a much more robust demand and those prices go up. So for right now, the labor market looks fairly stable, fairly much in equilibrium. Wage rates are going up 3-4%. That's pretty consistent with what we saw prior to COVID. Commodities are really wild card, beef in particular. So far, most restaurants are saying somewhere in that low single digit range for commodity inflation. But of course, things can change on a dime these days.
Yeah, Sara, a question on the demand side. I mean, we're starting to hear, we've heard it for the last year, but it seems to be accelerating in terms of the pressure the lower income consumer is under. And you see McDonald's going to a more value-oriented menu. I mean, they also have had specific problems where maybe things got a little stale, but I wonder if you see in general, a trend going toward more value-oriented and trying to lower prices because they want to make sure demand keeps up.
Yeah, I mean, I think that's that's a very accurate assessment of what's happening right now. I mean, the lower income consumer has been under pressure. Frankly, we've been hearing about that even since I would say as far back as 2022, but really, in a more pronounced way in 2023. So, 2022, as the stimulus payments were rolling off, we were starting to see that. But now it does feel as if it has, if not accelerated, certainly it's not improved, even as we are lapping against a couple of years of soft demand by that lower income consumer. So, I don't think any restaurant has a choice but to offer very strong value. Can't only be value, but absolutely after a couple of years where restaurants took relatively high price increases because their own input costs were going up so much, we are certainly in an environment where you are seeing a little bit more of a shift to value. Again, it may even just be something as simple as underscoring value that's already on the menu, abundant value that's already there. Right. But certainly restaurants are at the very least talking about value more, and in many cases actually offering more value.
Sara, I want to get specific with you, and I want to ask about Chipotle in particular. I know that you hosted them at a recent conference. I know you have a buy rating. The stock down 17% year to date alone. And there do seem to be some concerns here, maybe around that value proposition. I don't know. I'm curious to get your take here on whether it sounds like you think from the buy rating that people should be stepping in here.
Yeah, I think this is an opportunity. I mean, I'll say, first of all, most restaurants have been under pressure year to date because the consumer, certainly the consumer, the data have been cloudy. So, talked about calendar shifts. We talked about, weather. So it's been hard to know exactly what's happening. But it's also the case that, in a period of economic uncertainty, there is a sense among investors that maybe some of this more discretionary spending, which includes restaurants, might shrink. And I think what we're seeing right now is that is not the case. And Chipotle does have a very strong value proposition. So the pressure on the shares is sort of, fear about what might be. And again, we don't think it's the highest probability outcome as opposed to what's actually happening, which is the company is executing well.
Sara, thanks so much. Good to see you.
Good to see you. Thank you.